Good morning, everyone. Happy Monday, and welcome to NYSE TV Live. I'm Kristen Scholler here in studio above the iconic trading floor. And November trading is officially underway after the major indexes ended Friday higher following that October jobs report. Well, as my markets guest and friend of the show, Jay Wood, said on Friday, we are now embarking on the strongest 6-month period of the 12 months by historical standards. Well, the S&P 500 is already up 21% this year. Earnings and economic growth continue to take this stock market higher. We have a lot to monitor this week as earnings come in. America officially heads to the voting polls on Tuesday, if you haven't voted already. And the Federal Reserve delivers its latest decision on interest rates on Thursday. Let's take a look at what is on tap in today's show. Well, as Americans await an expected rate cut by the Fed on Thursday, I'll check in with Intercontinental Exchange's Vice President of Research and Analysis, Andy Walden, to see how the housing market is faring. Plus, with the election so near, Michael Rankin, Director of NYSE Research, will join me in studio to talk how traders are positioning themselves heading into this week. And with candidates making their final campaign push over the weekend, resident political expert JD Durkin, host of Common Threads and an NYSE floor reporter, will share the candidates' closing arguments. Well, even as the election has yet to play out, likely the biggest market-moving event this week will be what we hear from Fed Chair Jerome Powell on Thursday during the central bank's post-decision presser. The Fed is largely expected to lower interest rates on Thursday, regardless of the election outcome, and that has the housing market in focus. Intercontinental Exchange, the parent company of the NYSE, releases its mortgage monitor at the start of every month, and the latest one is out today. Joining me now with more is Andy Walden, Vice President of Research and Analysis at Intercontinental Exchange. Andy, good morning.
Good morning, Kristen.
It's great to have you on the show as we start what will be a very busy week with housing in focus, as I mentioned. And I know ICE recently released its September home price index. What are your biggest takeaways from the September housing market data?
Yeah, and I think there's a number of different things that kind of jump out when you look at September data out there. One is that the housing market continues to cool. The annual home price growth rate fell below 3% for the first time since July of 2023. And so you're starting to see the heat come out of the housing market. And that's really true across the country. We've got the lowest ceiling that we've had in 2 years out there as well. St. Louis saw just over 6% annual home price growth, which is the lowest high end of the market, if you will, that we've seen in a couple of years. The other thing that really catches my eye when you start to look at housing market data over the last 30 days, inventory continues to improve. That's the 8th consecutive month we've seen a little bit more inventory coming out there in the market. And sellers peeked their head out a little bit in September as well. We were still seeing a deficit in terms of the number of homes coming on the market in the month of September, but the shallowest deficit that we've seen in 2 years. And so that'll be a trend that we'll be watching closely over the tail end of this year and into 2025.
I think that inventory note that you mentioned just a few moments ago is certainly a positive for potential buyers out there, Andy. We know higher home prices do positively impact existing homeowners across the country. How much equity are they sitting on at the moment?
Yeah, we're actually seeing record levels of equity out there for homeowners. A little over $17 trillion held by mortgage holders across the U.S., a little over $11 trillion of what we call tappable or lendable equity that could be borrowed against while still maintaining a pretty healthy 20% equity stake in their homes. And so the potential for some more lending and borrowing activity out there from a home equity standpoint, you're also seeing, along with that, very lightly leveraged homeowners as well. If you look at total first and second lien mortgage debt, it's equivalent to about 45% of underlying home values. That's traditionally over the last 20 years been closer to 58%. So again, pretty lightly leveraged, heavily equity in the housing market.
In this environment, does the data show that homeowners are borrowing against their equity?
Yeah, I think the answer to that is yes and no. When you look at the third quarter of this year, you saw $48 billion extracted from the market via first lien cash out refinance activity, via second lien home equity line of credit activity. All three of those total equity withdrawals home equity line of credit withdrawals, first lien cash out refinance withdrawals. All three of those hit 2-year highs. They were slightly up from the second quarter of this year. And so you are seeing more equity withdrawn than we've seen over the last couple of years out there in the market. On the opposite side of that coin, borrowers are still being relatively conservative in terms of the way and how much equity that they're withdrawing from their homes. Over the last 2.5 years, we've seen about $500 billion withdrawn from the market in terms of home equity withdrawals. We've seen another $500 billion that has not been withdrawn and flowed back through the broader economy. So folks withdrawing equity at about half the rate that they traditionally would. Now that could change over the next 12 months depending on where the Fed goes with rates.
Yeah, let's talk more about that, because I do believe that could be the biggest market-moving event this week, despite a full plate certainly ahead of us here at the stock exchange. And so with traders betting that the Fed will cut rates, Andy, by 1/4 percentage point on Thursday, how do these declining rates impact the cost to withdraw home equity?
Yeah, and when you look at mortgage rates themselves, that Fed rate reduction later this week is largely already baked in. When you look at mortgage rate futures, Fed action largely already baked in there as well. The area that we could see a much more direct impact is on second lien home equity line of credit offerings, right? The Fed rates tend to pretty directly impact the prime rate. HELOCs are set on a spread to prime. And so when the Fed moves interest rates by 1/4%, like you mentioned, they're expected to later this week, that directly flows through the market in terms of lower home equity interest rate offerings, right? And that could significantly impact the cost to borrow against home equity in the U.S. We look over the last 20 years, right? And we look at this in practical matters. To borrow $50,000 in home equity, the typical monthly payment on a home equity line of credit is right around $200 a month, slightly above that, to borrow $50,000 in equity. As the Fed has put upward pressure on rates, that's gotten over $400 per month to borrow $50,000 in equity earlier this year. Given the recent Fed rate cuts we've seen, given the expectation for later this week for another cut, and cuts throughout 2025, home equity interest rates could go from over 9.5% earlier this year down into the mid to low 7% range. As we get towards the tail end of 2025, that could take that $400 a month to borrow $50,000 in equity down to $300 a month, and make it more attractive and more affordable for folks to start to borrow against some of the equity in their home. And you could see some of that activity pick up as we move towards the middle stages of next year.
Andy, I do want to quickly hit on the jobs report, of course, out on Friday, revealing a negative impact from Hurricanes Milton and Helene last month, with just 12,000 jobs added. How have we seen those weather events impact housing?
It had a significant impact this year. If you just look at the number of mortgaged homes that have been in the path of these three storms, Beryl, Helene, Milton, you're talking 6.1 million mortgaged residential properties. That's over 10% of mortgaged homes in the U.S. that have been in the direct path of a storm, according to our ICE climate data. And so you're seeing some significant impacts. I think that could mean two different things for the market. One is when you look at mortgage payment activity. We're already seeing in Houston and surrounding areas, following Hurricane Beryl, there are about 13,000 mortgage holders that have been financially impacted to the point where they're struggling to make their mortgage payment. You're already starting to see some of that same data come out from Hurricane Helene and Hurricane Milton as well. 3,500 folks already in September, even though that storm came in at the end of the month. 3,500 folks struggled to make their September mortgage payment right around North Carolina, South Carolina, and down through Florida. And the larger impacts, if you look at our daily performance data, are expected to come in October and November, given the timing of those storms. And so I certainly think there's financial loss in folks struggling to make mortgage payments that need help. A few weeks ago, we had also talked about property insurance costs out there across the U.S. and how the average property insurance payment is up over 50% over the last 4.5 years. I think it's fair to expect that in some of these hurricane hit areas and in the higher risk areas, that trend is likely to continue here over the next couple of years, which are going to continue to face pressure on those payments.
Andy, I'm glad we have you as our in-house expert to talk all things housing and, of course, increasingly the intersection of climate as well. That's Andy Walden, Vice President of Research and Analysis at Intercontinental Exchange. All right, well, we're going to take a short break, but when we come back, Trinity Chavez will be with us, fresh from Money 2020 in Las Vegas. Trinity will continue the conversation on housing with the National Association of Realtors following the release of its latest study. We'll have those details up next.
Hello and welcome to today's edition of The Exchange, brought to you by the New York Stock Exchange. I am live on the floor with my friend Simeon Hyman. He's global investment strategist at ProShares. Simeon, thank you for stopping by.
Thanks for having me.
I can't believe I'm saying this. We're coming up on the 3-year anniversary, of BITO, B-I-T-O. That's the ProShares Bitcoin ETF. How's it going?
You were here with me, October
I was here.
2021.
I remember we were staring at the screens behind us. We were excited.
The volume was off the charts. I think we had about $1 billion in the first 4 hours.
Yeah.
The fund has continued to prosper, and we keep moving. We now have the most crypto-linked ETFs as in addition to BITO.
So let's stay on the ETF. You know, we talk a lot about the benefits of the ETF wrapper. Are there benefits to the idea of Bitcoin in an ETF?
Sure. Let's start with the ETF itself. You can buy and sell in a brokerage account. You don't need a wallet. Now you have the futures, which are a regulated space as opposed to the loosely regulated spot markets and third-party providers, and you have a qualified custodian. But you bring up a second point, which is important, the distinction between our futures-based ETF and the spot Bitcoin ETFs. BITO is a 40 Act fund as opposed to the spot Bitcoin ETFs, which are 33 Act funds. And some folks do want a registered investment company or a RIC alternative. You also have options on BITO, very important. There aren't options on the spot guys, and it's a robust spot market, the largest of the crypto-linked space. And again, that regulated futures market is important.
It is. And, you know, as you mentioned, the options market, I mean, boy, options have just been booming this year. We're seeing it in messaging traffic. I want to take us forward, though. So it's been 3 years since BITO has been listed here at the New York Stock Exchange. What else have you been working on over that time?
We're up to 10 crypto-linked ETFs in our suite. We're super...
Good Monday morning and welcome back to NYSE TV Live. I'm Kristen Scholler here at the New York Stock Exchange. Well, we are at the start of another trading day here at the NYSE, and it'll be our first full trading week in the month of November. But before trading starts, let's continue the housing conversation as promised and check in with my colleague Trinity Chavez. Trinity, welcome back and good morning.
Good morning, Kristen. Yeah, that's right. It's great to be back. We're hitting the ground running on a busy Monday morning, but I do want to talk about these results from the 2024 profile of home buyers and sellers that has been released. And this report highlights shifting trends in the housing market, from a rise in first-time buyers to the growing appeal of multi-generational homes. Now, to dive deeper into the findings and break down what this means for home buyers, sellers, and the future of real estate, I am joined now by Jessica Lutz. She is the Deputy Chief Economist and VP of Research at the National Association of Realtors. Good morning, Jessica.
Good morning. It's great to be here.
So this report shows a notable rise in first-time home buyers to 32%, though it's still below the historical average of 38%. So what would you say are the driving factors that might be encouraging this increase, and do you see this trend likely to continue?
So what we actually saw is we did see that trend last year, but this year we actually saw a historical low of first-time homebuyers at just 24% of the market. That's the lowest share we've ever recorded in 43 years. And I think it really speaks to both housing affordability, the lack of affordable inventory, but also how inflation has impacted potential buyers out there with both rising rents, student loan debt, having to pay for grocery costs, so on, making it hard for first-time homebuyers to save.
Now, the report also highlights some demographic shifts in home buying as well. The average age of first-time home buyers has decreased slightly, while repeat buyers are also purchasing at a younger age. So what do you think these shifts really indicate about the current state of the housing market and the economic factors that are affecting different age groups?
So I unfortunately will say also that was from last year's report, but from this year's report, we actually found an all-time high in age, both for first-time homebuyers and for repeat buyers. So for first-time homebuyers, they're now a median age of 38 years old. And why that's striking is that if we look at that a decade ago, they actually were just 28. So we know that in in just 40 years, they have actually reached this all-time high, making it quite difficult for these first-time homebuyers to enter. The housing market is really dominated by nearly retirees. The median age of repeat buyers being 61 years old really speaks to a different type of housing market today.
So what would you say were the key takeaways for you throughout your research in this report that consumers and home buyers should know?
I think it really underscores just housing affordability and the lack of affordable inventory, but also home buyers doubling up. We saw an all-time high of multi-generational buyers at 17% of the entire market, which is very much a striking finding. The other thing that I think is fascinating is there's an all-time high of all cash buyers. So while we have an all-time low of first-time home buyers, all cash buyers really dominating the market, holding the cards in the housing market today.
Can you talk about more of the key trends when it comes to multi-generational home purchases compared to years past and what we're seeing in today's economic landscape?
So for multi-generational home buyers, we see them at such a high share. The number one reason to actually purchase a multi-generational home is for elderly parents to move in, for cost savings, for kids over the age of 18. So all of those reasons speak to really a crisis when we think about everyone living independently, having their own place, but then also thinking about elder care in this country, child care in this country, and young adults not being able to live independently given home prices.
And what would you say? I mean, you noted some factors earlier that are impacting people's spending power, right? Especially when it comes to home buying. So, with home-time buyers, some of them are citing that they can't afford homes because of saving capacity. Obviously, we're seeing inflation rates in the current economic landscape. But what else are you seeing in the sector as to why people are having challenges when it comes to buying their first home?
So in this data set, I think it's important to note that this actually does capture the time period when interest rates rose to nearly 8%, which was the highest in 2 decades. It also shows a time period when student loan debt is back on and people had to resume those payments. Both of those factors would hold back potential buyers from saving, but then just the cost of goods overall. So thinking about credit cards going up, thinking about car loans going up as well. And so that makes it quite difficult for consumers to save.
Now, obviously, we're in, the presidential election. We're going to get those results shortly. So, how do you think this will impact the broader housing sector? What do you think we can expect come 2025?
So I think moving forward, we are already starting to see more inventory come into the market in the last couple of months. More people are loosening from the grips of those low interest rate mortgages. So with that, we could see more movement in the market, and that's certainly better for first-time home buyers. We also know that interest rates have come down. That's certainly good news too, though in recent weeks they've ticked back up. We're not seeing them as high as last year, and that's certainly a good thing too.
Now, we have about 60 seconds left, Jessica. I do want to ask you, as you know, people are more price conscious when it comes to purchasing their first home or perhaps a second home. Are you seeing more people work with brokers? I mean, because some of them you have to pay a significant broker fee.
We are. So we actually are seeing that still 9 in 10 consumers want representation. This is the biggest financial transaction of one's lifetime. So having representation both to sell one's home, but also to purchase a home is incredibly important. And as we talked about, it's difficult to even find a home. So having that representation to guide one through the market is very important as well.
And of course, that varies from state to state and region to region, as the trends are different everywhere you go. But thank you so much, Jessica, for all those key insights. We appreciate having you on the show. We look forward to having you back soon.
Thank you.
I'm going to send things back over to my colleague, Kristen Scholler in Studio One. Kristen?
And Trinity, thanks so much. Of course, Trinity is going to join us on the floor here in just a few moments as Digital Realty gets ready to ring the opening bell. But certainly a lot changing on the mortgage and home buying front. And we'll talk more about that very topic relevant to today's program, this week's coverage, and of course, the bell ringer on the other side of this short break.
Hi, I'm Isabella Bazone with Fixed Income in Focus. Today, I am pleased to have with me Laurent Poyac, Group CEO at Millennium Advisors. Laurent, in the world of credit, we've seen a lot of change in market structure in the last 10 years with the growth of algo trading and all-to-all platforms. How have these new developments affected liquidity in fixed income markets?
Well, first of all, thank you for having me, Isabella. You have run a very good program. I'm pleased to be here. I'm going to share my perspective as a prop trading firm that has acted as an alternative liquidity providers in fixed income. Yes, market evolution has really transformed our markets for the last 10 plus years. With the advance of algo trading, we've seen a lot more participants. Now, every single investment bank and have an algo desk, as well as alternative liquidity providers like prop firms are very active in the algo trading space. With more data and the usability of AI in those markets, algo trading firm has created a lot of value. But what we found is that the liquidity they provide is really robust, mostly in a low volatility environment. All-to-all platform have also expanded, and there's more than one platform today, and it's really blurred the line between the buy side and the sell side. But again, liquidity has been strong, mostly during low volatility environment. At time of market disruptions, that's where we see the weakness of these evolutions. We all say that in the credit markets, liquidity is a mile wide and an inch deep. And at Millennium, we approach it a bit differently. We use algorithms to help us making decisions, but our model is really more trader-centric. And we use automations to help our people make faster and better decisions and respond.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio as we await the opening bell on Wall Street. Well, the American dream of buying a home often seems out of reach, certainly these days. With the Fed expected to lower interest rates again later this week, that dream may be making a comeback. Tim Bowler is the president of ICE Mortgage Technology, and I recently spoke with him about the mortgage products and platform that his group provides. He explained that they listen to the demands of loan originators to create products aimed at engaging first-time buyers and simplifying the process both for obtaining and servicing the loan. Let's take a listen.
This is, the number one ask that we get from our mortgage originator clients is how to try to help them be as thoughtful and dynamic as possible and engaging with that first-time home buyer in order to try to make it easier. And that, from our perspective, really comes down to streamlining the underwriting process, making certain that every loan that's possible to be made to that individual buying that first-time home is made available to them. It's really, really important to us to make certain that that lender can then work with that family to find the right option to help that first-time home buyer. And then, once that first-time home buyer is in the house, making certain that the servicing software that is used to collect the payments and manage that loan is as simple, straightforward as possible. And also, if that household ever faces a hardship, is easy to navigate so that household can effectively basically ask for help in either a digital form if they feel most comfortable, or through a live individual that they might reach out to through that technology platform. And we've designed both.
Well, another area that Tim discussed is the need to address the housing affordability crisis facing this country. He believes that home ownership is the best way to build wealth and provide stability, and this benefits not only individual families, but really the nation's entire economy.
A housing finance system that works provides unbelievable value to the U.S., to our economy, and most importantly to families, because there's no better tool for wealth creation and generational stability than home ownership. I've seen that time in and time out in this country. One of the things that's really made me happy about what I'm hearing out of policymakers, certainly over the last 6 months, is much more universal acceptance that we do need an all-of-the-above approach to try to address the housing affordability crunch, crisis, whatever word you want to use, that exists in the country today, particularly for that first-time home buyer.
We also discussed the vast data and analytical resources that ICE Mortgage Technology, part of Intercontinental Exchange, can provide to loan originators and loan servicers. This information enables them not only to gauge various markets, but both first-time loans and refinance loans using climate data to better equip them to provide accurate risk assessments. Well, again, the goal being to tailor the solution to each potential client and then position the loans for potential investors.
ICE has this unbelievably rich data and analytics library that can be provided to originators or servicers. So just use your, your point of reference with McNash and servicers. It's, there's our market data that we can provide to servicers through McDash. It's our climate data that we can provide through a number of the ICE data services technology offerings that we have that can help our servicers think and evaluate climate risk for properties. It's the market data that we have across Intercontinental Exchange that can help inform, mortgage servicers and lenders for that matter about what's the right way to optimize engagement with the household around refinancing. And then once that loan's financed, how to sell that to an investor on an optimal basis. And that goes back to, fundamentally us having incredible data sets, incredible analytic sets that can supplement the underlying software that we have that helps facilitate the process of originating a mortgage efficiently or servicing a mortgage as efficiently as.
Well, in a very timely conversation, Tim also touched upon the automation and AI that is becoming prevalent in these loan transactions. He was quick to point out that it is very important to still keep the human element in the process. While automation and AI should be used to help facilitate and inform people, the average American family still wants that human touch. It's one of the biggest financial decisions most individuals or families ever make.
When you get a mortgage, it really is either the biggest financial decision or one of the biggest financial decisions that any individual or family will make. And, part of that, with that being the case, that home buyer is probably going to want somebody with them, another human being to be a part of that process. That's why when we think about, generative AI or some of the new automation or machine learning tools, it really is all about helping that lender, that individual that's working with that that family to buy that home, how to basically automate and efficiently get information to that individual as quickly and as efficiently as possible. There's tools out there that can help facilitate that human-to-human interaction to make certain that the right advice is being given, while never fully turning over the underwriting process to a machine. Given the fact that this is far too important of a process for the average American and the average American family to not have somebody be a part, not have another human being be part of that process.
Well, the good news is that the entire podcast with Tim Bowler, president of ICE Mortgage Technology, is now available inside the ICE house. You can listen, of course, wherever you find your podcasts. All right, well, ringing the opening bell this morning, sticking with the housing theme and automation, is Digital Realty Group. It's a real estate investment trust celebrating its 20th anniversary of listing here on the exchange. And this REIT is under the leadership of CEO Andy Power, who's going to be joined on the podium by the director and chair of the board, Mary Hogan. Now, as we await for the bell, let's take a look at some of these NYSE listed companies set to report earnings this week. It is going to be very busy. We've got Cloudflare, Pinterest, Palantir on tap. Trinity, I know you're on the floor awaiting this bell and looking at some of these companies as well.
I want to give you a sense of the pulse on the floor as we're gearing up for another busy day of trading. It's very calm right now, even though the market's hovering slightly lower as everyone is on high anticipation as, waiting this election results. A lot of people, their sentiment is that we should know an outcome late Tuesday night. But again, that is just some of the chatter that's happening here on the floor. But as you said, Sweet Green, WK, Kellogg, Warby Parker, these are some of the companies that are going to be reporting earnings later on in the week. So, we're going to be off to the races here soon, Kristen.
And Trinity, we're awaiting for Digital Realty to celebrate that opening bell. I see some of the crowd behind you. You mentioned a busy week. You're right. Kenvue, TKO, Grindr, Elf Cosmetics, just some of the other companies set to report their earnings this particular week. Talk to me more about the pulse on the floor. I'm sure many traders happy to see you back after your time in Vegas for Money 2020.
Yeah, no, it's great to be back here on the floor. And as I said, the sentiment right now is fairly calm as we get ready to open up the U.S. equity markets and see Digital Realty right behind me on that bell podium. Millions of people from around the world are tuning in to see who's on that podium, ringing the opening bell to kick off trading for the day. And as a matter of fact, we're about 7 seconds out. So let's listen into that, and we'll be right back after the bell opening.
officially off to the races in what is said to be probably the busiest week that we have had together yet on this show at NYSE TV Live. We see a bit of a mixed market here at the open between earnings, the election, and a Fed decision, all set to take center stage here at the NYSE. So joining me now with more as we are officially off to the races is Michael Ranking. He's a director of NYSE Research. Michael, it's great to have you on the show.
Hi, thanks for having me back.
All right, a lot for investors to parse through this week. What do they need to know as we begin this week together?
Yeah, I think maybe it's just expect the unexpected, right? So, we have so many big catalysts this week. Obviously, the election tomorrow is at the forefront of investor minds at this point. The Federal Reserve, as you mentioned, has their meeting on Thursday. I think markets widely expect them to cut by 25 basis points. That was really cemented, by the kind of the weak jobs number that we had on Friday. But I continue to look for some volatility, right? Because we're not necessarily going to have a kind of an outcome from the election tomorrow. So we'll see how kind of investors digest that.
How would you describe volatility for our viewers watching? Are we talking maybe a few percentage point moves, higher trading volumes? What would it be?
Yeah, so well, interestingly enough, so it would be a little bit of both, right? But we haven't really seen the volatility that everybody had expected, kind of heading into the election. This has been one of the least volatile periods heading into an election that we've seen, especially considering kind of the divisive nature of this election particularly. Where we're seeing a lot of volatility, not necessarily in equity markets, is really in the treasury markets, right? And that kind of relates to the potential fiscal, kind of the large fiscal deficits that we have, and kind of and how we're going to deal with that in 2025. And that's going to be one of the real big topics that we going to have to work through next year, no matter who's in office.
So as we await the election results and of course earnings this week, I do want to talk a bit about last week, which was also an extremely busy week between earnings and of course that jobs report on Friday. So we had started November trade on Friday, only 12,000 jobs added in October, but of course skewed because of the Boeing strike and weather events like Hurricane Helene and Milton. Why do you think that the market shrugged that off? We had actually seen stocks rally to start the month of November.
Yeah, so as you pointed out, I think the main reason, right, that there's some with the weather result, with the hurricanes, right, and the strike impact, right, there's people like the market isn't putting too much weight in this one particular number. I always sort of say don't look at any single print, right? Look at things kind of over a couple periods, right, where take a 3-month average or something along those lines, right, to really understand. But I think markets are discounting that. The most interesting thing was once again in treasury yields, right? So following that weak report, we saw treasury yields back off, and they've been moving higher. That's been one of the concerns that's been building in the markets. They did back off following the report, but by the end of the day, we reversed over 15 basis points to the upside. And that was, kind of, a little bit of a shot across the bow, but I thought it was really positive that markets, once again, kind of shrugged that off a little bit, and we were able to hold on to gains, despite that move.
Another storyline that we've been following in real time here is the announcement that NVIDIA is going to be added to the Dow. What does that mean for the average investor?
Yeah, so you will see, some money flow into NVIDIA. But the S&P 500 is really where you see most of the assets under management that really kind of benchmark to that index. So that's a bigger deal for a particular company or stock if they're added to the S&P as opposed to the Dow. It's just not as much AUM tracks that index.
AI seems to be the biggest buzz term this year, probably of the past 18 months. Actually, the bell ringer, Digital Realty, does play in this AI infrastructure space when it comes to its real estate investment trust business. But we had seen the tech companies report last week, the most richly valued companies. Did investors hear what they needed to hear from them when it came to the AI investments?
Yeah, so within that kind of group of stocks, we haven't seen this monolithic move that we had seen over the previous 2 years, where all of the kind of the names within that NYSE FANG Plus index were all moving in one direction. There's a lot more dispersion that we're seeing at this point. Broadly, I'd say the numbers were pretty solid, right? The companies continue to suggest that we're seeing investment in the space, and they're planning to continue that investment. Markets, investors need to kind of come to grips with the idea that that investment cycle is going to take some time. We're not going to necessarily see that impacting the bottom line kind of right away. But I think overall the market has kind of digested that.
quickly, top 3 companies reporting earnings that you think are important to watch this week.
Well, so I mean, I'm actually going to twist that a little bit, because just to go back to your AI kind of highlight. So this morning we had Constellation Energy had reported. They actually put up good numbers, and they've been one of these nuclear players that we're seeing that's really been driving gains within the utility sector. Over the week, or on Friday, we had the Federal Energy Commission block a deal between Amazon and Talon Energy, where they had agreed to a long-term power supply agreement to help power those AI data centers. We're seeing a big unwind of some of that trade coming on the back end of that announcement on Friday. So that was kind of the one. I think from a market perspective, we've heard from the biggest companies. We had Berkshire Hathaway over the weekend. Their numbers were pretty solid, but they did get weighed down a little bit by catastrophe losses, which makes some sense given just how big of an insurance business they are.
Yes.
And then from a broader market perspective, the number of companies that'll continue to report this week are going to be heavy. But I think until we get to the retail earnings in about a week or two, that's going to be really the next big catalyst from an earnings perspective.
Wish we had more time. Michael Ranking, Director of NYSE Research, thank you so much.
Thanks for having me.
All right, well, stay with us, because up next we will head back down to the floor with Trinity Chavez to talk more about this ever-increasing demand for power.
Technology is very important to us. Actually, we are one of the first companies in the industry to fully adopt cloud-based software applications.
Stephen, it is wonderful to have you on Floor Talk here at NYSE International Day.
Thank you. Thank you for having me.
So now, I want to start off by talking about the company. Tell me about NYSE.
Thank you. So we are NYSE, short for CYYS. We are China's largest freshly made tea drink company. So we are directly operated. Currently, we have 900 stores across the country with more than 6,000 employees. So we were founded in 2013 in Changsha City from China. So on top of the fresh made drinks, we also offer lifestyle retail products like these ones. So we started offering them since 2020. Right now, it contributes to more than 30% of our total sales. To my knowledge, that is the highest in the industry.
Now tell me, how does technology drive the customer experience?
Technology is very important to us. Actually, we are one of the first companies in the industry to fully adopt cloud-based software applications. Just to give you an example, so people are familiar with the Starbucks apps. There are a lot of functionality in it. So we also have a similar WeChat mini program in China. So for example, if a customer is interested in to buy one of these retail products, they can use our WeChat mini program to search exactly which store has the inventory. And once they find it, they will be able to either to buy it or they
Welcome back to NYSE TV Live, everyone. I'm Kristen Schuller here in studio, and as promised, let's send things down to the floor where my colleague Trinity Chavez has more. Trinity.
Thanks, Kristen. Yeah, so one of the stories that we have been watching is about the skyrocketing power demands thanks to the growing presence of course, AI. GE Vernova is pioneering ways to manage this surge while also keeping carbon emissions in check. Joining me now to talk more about this is GE himself. Apologies. Can you hear me okay?
I can, Trinity. Can you hear me?
Yes, I can hear you now. Okay, so let's just dive into this conversation. In your experience, how much power do data centers consume?
So, Trinity, GE started the electrification revolution 130 years ago, and today we're excited to be leading this version of the electrification revolution. And when we talk about data centers and generating power, we really see this as a huge opportunity to kind of meet two goals at once. We want to electrify the planet, and we want to decarbonize the energy sector at the same time. When we talk about electrification, energy is prosperity. And when it's not just data centers driving this demand, it's manufacturing, it's energy security, it's also just sustainable economic development. And when it comes to decarbonization, every dollar we spend on electrification is helping to decarbonize the grid. Just to share with you, in 2023, GE Vernova added 29 gigawatts of capacity onto the grid, the carbon intensity of that capacity was 25% below the average of the grid itself. So by putting more capacity on the grid, we're actually bringing down the carbon intensity. So we're embracing the demand being driven by data centers and other factors because we see it as great for electrification, but it's also making progress on driving decarbonization at the same time.
Now, Roger, I also do want to talk to you about how GE Vernova is managing the increase of demand while also reducing the carbon footprint that we're seeing.
And it's through really in all of the above strategy. If we're going to meet the demand for data centers, all the other needs for demand that we have, we really need all the technologies on the table. So for example, we start with gas power. Gas power is kind of the foundation for meeting the demand. It's the dispatchable, reliable 24/7 energy. And it helps lower the carbon intensity of the grid today. It lowers those emissions. But at the same time, it also can be decarbonized long time through hydrogen and through carbon capture, through long-term breakthrough technologies. We're going to grow renewables as quickly as we can this decade. We're seeing more renewables play a bigger role every year on the grid, and data centers are relying on renewables to play an increasing part of the pie. And then what gets really exciting is the next decade. We're going to see small modular nuclear reactors come online late this decade, early into the next decade, providing a third source of power for data centers while we're decarbonizing the gas through hydrogen and carbon capture. So it's all of the above strategy to really help meet the demand and make progress towards decarbonization goals at the same time.
And speaking about meeting the demands, Roger, I do want to point to a study that, according to Goldman Sachs, AI could potentially drive up 160% increase in data centers' power demand. So from your vantage point as the Chief Sustainability Officer and Head of Government Affairs for GE Vernova, what are the challenges right now that we're seeing in this landscape, and how are you staying ahead of this? And is this data that you yourself have heard of, a 160% increase?
We're starting looking at that, and we're looking at really a doubling of demand across the grid by 2040. So again, data centers are part of it, but we really focus on how do we meet that imperative to where the world needs a double of capacity by 2040, something we haven't seen in decades, and we have to rise. So there's certain things that are in our control. What's in our control is the ability to deliver the products the world needs, whether that's gas power, renewable energy, grid and electrification equipment, the next generation of small modular reactors, hydrogen, carbon capture. So we're increasing capacity in our factories, we're hiring people, and we're really upping our capacity to meet the demand from data centers in all of our businesses, as well as the overall goals for electrification. But some of that's in our control and some of it's not. And so we're partnering with the hyperscalers, we're partnering with the public sector to really build systems of systems. So we can take an infrastructure-wide approach, a system-wide approach to help everyone solve for this at the same time. I think tomorrow's this is going to be on the plate of whoever wins on Tuesday. Certainly a priority, and we're appreciative of the partnerships we have, public sector, private sector, to lead in this area together.
A lot to look out for, Roger. Thank you so much for those key insights. Again, Roger Martella, Chief Sustainability Officer and Head of Government Affairs for GE Vernova. Thank you, Roger.
Trinity, thanks.
I'm going to send things back over to Kristen in studio.
Hi, Trinity, thanks so much. Great conversation there, of course, tied to the sector of our bell ringer. Many of you, though, probably have taken advantage of early voting, whether it was over the weekend, this past week, or the mail-in ballot option. But tomorrow, November 5th, is officially Election Day. The NYSE and its parent company, Intercontinental Exchange, want to remind you that your voice does matter and urge you to vote. Take a look.
Together, we achieve greatness.
A house divided against itself cannot stand.
Ask not what your country can do for you, ask what you can do for your country.
One small step for man, one giant leap for
mankind. You think about it, providing energy does improve lives. Your life gets pretty miserable pretty fast if the lights go out, if you can't get the fuel you need to get from point A to point B, groceries don't show up on the shelves, you can't get your kids to school. It's a tough life without energy. And so our mission is to make sure that people have access to the energy and the materials they need to have a great lifestyle, to have a sustainable lifestyle. And over the years, we know that it's going to evolve. The kind of energy we may be providing to improve people's lives may evolve from what we do today, but we're committed to ensure that people access have access to low-cost, affordable, sustainable, abundant energy, just like we've done for the last 125 plus years. Pinnacle really epitomizes the perfect opportunity for us because it sat right next to our backbone, our trunk lines. It had a brand new state-of-the-art gathering and processing facility that could process 200 million standard cubic feet a day of gas, and it had plans for another one and the utilities in place for another one, and there's room for even more expansion. So we could do an inorganic acquisition that allowed us to do more organic growth over the long term. And so we were able to buy it at a very reasonable value and create even more value by expanding it over time. Today, we're now processing 50,000 barrels a day, give or take a little bit, of renewable feedstocks with low carbon intensity, and we're selling it as renewable diesel direct to customers at our 76 stations in California and other locations on the West Coast. And we're now starting to build inventory of renewable jet fuel that can be blended with traditional jet fuel and marketed as sustainable aviation fuel. So we're well off to a good start with our Rodeo.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio. Well, with the election on deck tomorrow, each campaign is making its final push to voters. Former President Donald Trump rallied in Pennsylvania over the weekend, while Vice President Kamala Harris took to a church pulpit in Michigan after appearing on Saturday Night Live. So how will this election impact you, and what does it mean for markets and your money? Well, joining me now to break it down is resident political expert and host of Common Threads, JD Durkin. JD, it's great to have you on the show.
Good morning. First of all, I appreciate that kind intro, and I can't believe that we're actually here on the eve of the election.
Here.
We talk about this for years, and it never feels like it's going to be here, but great to be here with you for an awesome week.
It's great to have you. So let's start by getting our viewers caught up. Of course, we had that disappointing jobs report on Friday. We knew that probably these candidates would use that as final talking points heading into Election Day. How have we seen that narrative transpire?
Especially use it for fuel. If you are former President Donald Trump, you're trying to get back into the White House. Obviously, the Trump campaign was very quick on Friday morning. It wasn't not even 9 a.m. on Friday. The Trump campaign out with a statement. They called it brutal. From their perspective, they're framing this as a failure of Bidenomics. And of course, we heard from former President Trump later on in the weekend speak about it in really harsh tones. He's trying to say, hey, look at this top line figure. This is the very problem with the incumbency and why you should vote for me. As for Democrats, they've been more inclined to say this is not really in line with the overall trends that we've seen. This is because of storms. This is because of strikes. Let's not forget that 2.8% GDP reading we got. Let's not forget unemployment still near a historic low at 4.1%. Kristen, you know better than anyone. When we get these jobs reports, you get different surveys, different bits of information. Both campaigns conveniently going with the ones that they think strengthen their case days before people go to the polls.
I think you bring up a good point, though. Of course, this jobs report vastly skewed by those hurricanes, 2 of them last month, as well as that Boeing strike. So we'll see how it shakes out on Election Day tomorrow. But what did the final pre-election polls, JD, tell us about which candidate voters think is better equipped to handle the economy?
Of any of the polls out there, my absolute favorites are the one that ask voters, who do you have more confidence in to handle stewardship of the U.S. economy moving forward? And for the vast majority of this year, Kristen, it clearly has tilted in Donald Trump's favor. The good news for Vice President Kamala Harris is she managed to really close that gap in the final weeks. You look at the New York Times Siena poll, ask likely voters a version of that question. Donald Trump had a 13 percentage point lead. They did the same poll to the same type of voters just 4 or 5 days ago. Vice President Harris managed to narrow that down to 6 points. So the challenge is still certainly there. I think the advantage to former President Trump is that in these key swing states in Arizona, Pennsylvania, Michigan, he's actually doing a bit better than that 6-point national margin. That speaks to his benefit and really the perception of voters out there that it's the Republican Party and Donald Trump who they feel at least talk a bit better about economic circumstances.
The Wall Street Journal had a great story recently about how economists think each candidate will have an economy that would play out if they are to be elected. And of course, the disparity there between voters as well. And so that dynamic certainly always at play, JD. But what are the closing messages, the closing arguments, if we will, that we hear from these campaigns, specifically to the business community?
Yeah, I think from Donald Trump, it continues to be higher tariffs, lower taxes. And he's going to look at the 2017 Tax Cuts and Jobs Act, also known as the Trump tax cuts affectionately here on Wall Street, and remind people in the business community, your tax cuts that you love that we passed years ago, they're set to expire at the end of 2025. Therefore, vote for me, and the Republicans will get these over the finish line for you. Again, it's been interesting to watch Democrats and Vice President Harris make the rule of law argument in terms of the economy. In other words, saying, look at the chaos that Donald Trump can bring. That's what they say anyway. And markets want stability. You also don't want, so says Vice President Harris, President Trump, who will individually target CEOs, may individually target businesses, and therefore rattle investor confidence. So bit of those dueling messages down the stretch. That has been the name of the game for the last month, and I noticed that really front and center with campaign events in places like Wisconsin, Michigan, Pennsylvania, North Carolina, and Georgia, where both candidates were zipping back and forth between all those swing states the last 72 hours.
I know you've been following the Elon Musk factor here as it relates to the election. How did he spend his time and efforts specifically endorsing former President Trump here as we get closer to Election Day?
I don't know how Elon Musk managed to run the number of businesses he does, because I feel like he is on X, his platform formerly known as Twitter, basically full-time. According to one New York Times count, more than 3,000 posts in the last month alone. So he's really cornered this incredible piece of digital real estate, the likes of which we haven't had, and for his perspective, to back the campaign of former President Trump. He's also made a handful of key in-person events in recent weeks, right? Last Sunday, he was here in New York City for the MSG rally. He was alongside the former president in Butler, Pennsylvania. And we can't forget about his pro-Trump super PAC, more than $130 million from Musk personally to boost battleground swing state voter support, make sure people are registered, make sure they're out there to support Donald Trump. That's a really interesting dynamic, and we'll see how it goes, whether or not it pays off. But I can't remember, having done this for a while, really someone in Elon Musk's position leveraging his power and quite literally his billions of dollars to try and support one candidate over another.
Yeah, interesting storylines that we definitely follow in the business world. Not so sure how much American voters, the average voter, might be following Elon Musk, but certainly worthwhile to point out. JD, I also want to talk about which sectors might be most impacted here. If you could just list a few, we're about short on time.
Absolutely. We've talked about the Trump trade, so look for crypto, the small cap stocks, which have done very well. Look for financial shares of XLF, the third best performing sector in the S&P. For Harris, I think home builders and some key healthcare names might look to drag down some of those profit margins for companies like Eli Lilly and Merck if they are able to put caps on prescription drug prices. But Harris has also talked about expanding healthcare coverage. Could be a benefit for names like Humana as well as UNH, United Healthcare, the most weighted name in the Dow.
Thank you so much. JD Durkin, of course, host of Common Threads here at the Stock Exchange.
Thanks.
All right, well, stay with us because a lot of good information for us to cover. More coming up on today's NYSE TV Live.
At Augury, we work with the largest manufacturing and industrial companies in the world to make their production lines more reliable, more productive, and more sustainable. And we do this by infusing every layer of the manufacturing stack with AI and digital solutions, starting from machine health, which is the maintenance and reliability aspects, as well as process health, which is process optimizations. How do I manufacture quality product? How do I reduce the waste? The energy consumption of my lines.
And speaking of machine health, let's talk about Augury's machine health since raising $180 million in funding.
You know, I mentioned we work with the largest companies, and what we've learned through the years is that the problem that we solve, machine health, is not just maintenance and reliability, it's a supply chain resiliency problem, right? It's a sustainability problem, a talent shortage, an upskilling problem. And you know, add to that the geopolitical tensions that we're living in, the environmental challenges that we're facing. I think the industry today understands that we have to fundamentally transform how manufacturing is being done, right? And as I mentioned, how do we bring AI and digital solutions to every single layer of the manufacturing stack? So what the funding enabled us to do in the past 3 years is not only continue growing our business, right? So today we're working in over 40 countries, as an example. We entered new segments with our partner Baker Hughes. We went into oil and gas and the energy sector. But on top of that, it enabled us to be bolder, right? To be that partner for our customers that helps them address the key challenges of AI and digital manufacturing in general.
Are there any specific technological advancements that Augury is focusing on to help enhance the production of health diagnostics?
Yeah, so we're always looking for ways to increase the coverage of how do we support more machines, more manufacturing.
Well, welcome back to NYSE TV Live, everyone. I'm Kristen Scholler, and for our viewers just tuning in as we get ready to round out this hour, this week has a lot in store. Earnings, the election, and yes, an interest rate decision from the Federal Reserve. Well, in fact, earnings have really ramped up with mentions of the election on earnings calls starting to surge. Several of my markets guests over the past few weeks have said that they are waiting to potentially make portfolio adjustments until after the election. And Americans are tuned in into what the outcome will mean, of course, for their day-to-day lives. Well, it's worth noting that while the Fed decision comes after the election, the central bank under Fed Chair Jerome Powell has maintained that that body is independent from politics. Rather, it's the economic data that drives its interest rate decisions. We'll wait to hear if the Fed chair has any remarks whatsoever on the election on Thursday when he does host a press conference with reporters following what is expected to be a 1/4 percentage point rate cut by the central bank. Of course, many NYSE-listed companies set to report earnings this week, including Cloudflare, Pinterest, Palantir, Sweetgreen, WK Kellogg, Warby Parker, Kenvue, TKO, Grindr, and Elf Cosmetics. Trinity, I want to bring you in from the floor here. It is going to be a very busy week for us on NYSE TV Live.
It is going to be a very busy week for us, although today it's a little bit tame on the floor as everybody is anticipating that highly anticipated outcome of this presidential election that, of course, we will be covering here every single day on NYSE TV Live. And, of course, we're going to see how the market is going to react to that, see if Fed Chair Jerome Powell addresses that at all, which I'm sure he will. So, I mean, this is just a lot to look out for. I'm sure this is just the start of a very busy week, Kristen.
It's great to have you back here, of course, Trinity, at the Stock Exchange after wonderful coverage from Money 2020 in Las Vegas last week. We're going to leave it there for the show today. Trinity Chavez down for us on the floor. Kristen Scholler here in studio. Stay with us because we will have a very busy week of coverage, including on Election Day tomorrow. You're watching NYSE TV Live.
In life, I'm reminded that it's not about the destination, it is truly about the journey.
My pleasure to greet you today from the center of the U.S. capital markets here at the New York Stock Exchange.
I want to just take a minute and not just talk to the people that are in the room, but I want to speak to the rest of the team around the globe. These are people that made this happen, and I know that there is no way we would be here if it wasn't for you.
Everyone at Flutter is proud to join such a distinguished list of companies on this great stock exchange.
Not many people get to do something big in this world, and we get to do something truly special.
This is such a wonderful place to both look back and look forward. Look how far we have come. I'm so optimistic about what lies ahead. It has been a privilege to be with you.